Before I start, I'd like to say a quick thank you to our sponsor, Fidelity International. You can find out more about them at fidelity.co.uk/money to the masses. Hello and welcome to the latest episode of Damien's Midweek Markets, the show where I talk about what's going on in investment markets and what to look out for in the days and weeks ahead. And what a week it's been. Just to give a brief recap, we're looking at the S&P 500 in America is down around 2%. The FTSE 100 has fallen about 3.5%. I mean, the S&P 500 has had its worst period since October in 2019. If we go and look at Asian equities, the situation is even more dire. If we look at commodities have sold off. We've had oil down about 15% since the beginning of January, since the 5th of January. In fact, if we look at copper, it's had one of its worst losing streaks in about 30 years. So what is going on? Well, there's a lot of moving parts. The big one is, of course, the coronavirus in China. Now, whenever there's a news headline surrounding the coronavirus, it has a direct impact on investment markets. So when it's a positive news story, like something along the lines that it seems the virus could be contained, the market starts to rally. And of course, when it's something opposite, like British Airways not flying anymore to China, or more people being quarantined, or a higher death toll, the market starts to pull back, because at the moment the market just doesn't know what it is dealing with. And if you want to get an insight into what's going on in the Chinese stock market, it's slightly difficult because they've had to close down their stock market. So their stock market at the moment isn't reflecting the realities around the rest of the world. So if you look at the futures market, on the other hand, then you get an insight to where the market is probably going to open when they reopen stock markets. At the moment, it's scheduled to reopen next week. Then there's going to be some sizable falls, because at the moment it's probably down around 9 to 10%. So those futures are predicting where the market is probably going to open come next week. So again, as I spoke about last week, it's more about where the epicenter of this virus is at the moment and where the troubles are, and where that's in the Far East and in China. They're the markets that have been hit the most. But there is a contagion carrying across to European markets and obviously US markets. But it's also, if you look at havens, so haven assets, things like gold and bond markets are being bid up. And the reason is because we're starting to look at the economic impacts that the virus could have if it's not contained, and it does in fact spread globally. If you think about it, when we had the SARS virus many years ago, the Chinese economy was a fraction of the size it is now in terms of the global domestic product. So in terms of the global economy, it was about 4% back then. It's about 16% of the world economy. Now, if you look at the news headlines and the video footage, you will see that with whole cities being put into quarantine. In fact, Starbucks has said this week they've closed 2,000 of their coffee outlets in China. The economic impact of this virus could be huge, because there is no transport going on. Business is not carrying on as usual. So there's even been official statements saying that the GDP for China in the first quarter of this year will be hit, and it'll probably be about 5% growth. Now, that sounds like a lot, but in China's terms, it's normally about 6%. So we're at the case that if the Chinese economy does become impacted by this virus, which is obviously very likely now, and it continues for a long enough period of time, it will start to impact global supply chains. It will start to impact companies overseas, so particularly in America, where their supply chains incorporate parts of China and Asia. It will start to cause a slowdown potentially in the global economy, and that's what investors are starting to get worried about. And you can see that if you look at the bond market, because the bond market has started to be bid up, so people are buying bonds as a safety play. And we've even started to see yield curve inversions once again. If you remember, I talked about last week or two ago, the one thing that the market could be at risk of, or what could bring down this rally, is if there was a sort of turnaround in the view on a recession. So the market previously, if you go back to August and into the early autumn, was pricing in the idea of a potential recession. It changed its mind, particularly after the Federal Reserve started boosting liquidity. It decided that there wasn't much chance of a recession in 2020, and so the market became very euphoric. But of course, now the idea that a recession might start to creep back in, and particularly with the Chinese virus potentially slowing down the global economy, it means that markets are suddenly having to try and price in the potential or the possibility of a slowdown in the global economy and a potential recession later in 2020. So you're starting to see defensive equity sectors rally and outperform cyclicals. You're starting to see that bond market outperform, and you're starting to see those warning signs, those inversions in the bond market flash. So while the coronavirus has been, of course, the big news story that everybody's watching, we've had earnings carrying on in America and around the world. So the companies announcing their earnings. And if you remember, I talked about 3 big tech companies, and they were Apple, it was Microsoft, and Facebook in particular that were reporting this week. And to sum up, we had 2 good and 1 bad. So Apple's results were outstanding. We had Microsoft's that were very good, and their stock price is set to rally today when the market starts in America. But on the flip side, we had Facebook, where the user growth disappointed, and so the outlook for them was slightly less than analysts had hoped, not perhaps as optimistic, and their share price fell immediately in aftermarket trading about 7%. So in terms of equity valuations, tech stocks were pushing the market higher, rallying to very extreme valuations. We were wondering if the earnings could back those valuations up. Now there's a bit of, some of them have been positive, some have been negative, so it's again a potential area of weakness for markets, something we need to keep watching as earnings season unfolds. And today, in fact, we've got Amazon announcing. So all these things go into the mix. The other big story this week was, of course, central banks. So we had the US Federal Reserve having a rate setting meeting. So people were wondering, would they cut interest rates? Would there be more sign of some form of liquidity, quantitative easing, or something similar? And in fact, the US Federal Reserve did nothing. It sat on its hands, didn't cut interest rates. But the positive thing it did say from markets perspective, not necessarily from an economic or philosophical viewpoint in terms of keep artificially inflating markets, they said they would continue some of their liquidity work, so some of their support for the markets into Q2, but they may start to withdraw that in Q2, and that could be a time when markets start to wobble, because obviously if you go back to October, as I mentioned in previous videos, the US Federal Reserve has been producing more quantitative easing. Even though it's not calling it that, it has the same kind of impact, which has driven the US stock market higher, and therefore it's driven global stocks higher. So after the Fed's decision yesterday, the market was obviously happy about the fact that they hadn't withdrawn any of their support, but obviously at the same time, there were some people probably wanting to see interest rate cuts, which they didn't get. So the market reaction was fairly muted after that. But they did mention, the US Federal Reserve did mention about the coronavirus. So it is a very real concern and its potential impact on the global economy, and they're going to watch it. Over in the UK, we've just had the Bank of England announce that they are keeping interest rates the same at 0.75%. So Mark Carney's last ever rate setting meeting as the governor of the Bank of England didn't cut interest rates as some people had started to price in. And as a result, sterling rallied and it leapt up about sort of 0.6%. And the strengthening of the pound will mean that any of your overseas holdings will probably take a little bit of a hit today unless it therefore pulls back. But one thing they did say in the statement, or hinted at, that there could potentially be rate cuts in the future, because they removed some of the wording to suggest they were going to be a little bit more optimistic about the future. There was signs that they are going to potentially cut interest rates in the future. Without explicitly saying it, it had a feeling of not if they're going to cut interest rates, but when in the future. So that's something to watch. So where we are right now is that markets have pulled back, and there is a sense that things may have changed. The market was really looking for an excuse to perhaps sell off slightly because it had been overly euphoric, valuations were a bit stretched, and the coronavirus perhaps has given markets an excuse to pull back, for some people to take profits. And what we've seen, not necessarily people bailing out of the market, but rotating into other assets or other sectors within equity markets, which is a very different thing for a complete sell-off and capitulation by investors. Now, another thing to keep an eye on in the next 24 hours is the announcement of US GDP numbers for Q4 last year, which will give an indication into the health of the American economy. If there's anything shocking in those numbers, particularly to the downside, then you may see a market reaction. So a lot is happening in investment markets, and it's getting pretty exciting. Now, that is it for this week on Damien's Midweek Markets. You can email me as usual, damien@moneytothemasses.com, via Twitter, moneytothemasses with the number 2. Of course, subscribe to our YouTube channel, and you can find us on Instagram and Facebook.